Hello, everybody. My name is DJ Wright, wealth advisor and portfolio manager for Financial Freedom Wealth Management Group. And today I'm here for your Financial Tip Tuesday, and we're going to talk about harvesting capital gains and losses. So this can be a great tax saving strategy for you. Now note that this is only for non-retirement accounts. These are also referred to as non-qualified accounts or taxable accounts. Some people call them general investing accounts, a lot of names for them. But it's not for retirement accounts such as 401ks, traditional IRAs, or Roth IRAs. Okay? So, to do this, you first want to start by reviewing gains and losses you have realized so far this year on any stocks, bonds, and other investments inside of any non-retirement accounts you have. So a realized gain or loss means you have actually sold the investment, okay? So then review any unrealized gains or losses you have in your account. So an unrealized gain or loss means you have not sold it yet, right? So you've bought a stock at $5, it's trading at $10, you still own that stock, that's an unrealized gain. Okay, so then what you can do is you can offset gains or losses that you have already realized by selling some of your unrealized gains or losses. So let's do an example here. Let's say you sold something at the beginning of the year for a $10,000 gain. Pretty good. This could be taxable for you in that year. So if you have an investment that has a $10,000 unrealized loss, you can actually go in there and sell it, and this will offset the $10,000 gain and clear any potential tax liability that you could have. Now, this works the other way as well. So let's say you have a realized loss. You sold something in January, $10,000 loss. You can go in there and sell one of your gains and offset each other. And then again, you would not be have any kind of tax liability there. So again, goes both ways. You can offset gains and losses at any time throughout the year. So there is a rule that you should all be aware of though, and this is called the wash rule. So if you were to sell an investment to realize a loss, you can't just go back in the next day and purchase it back. You've got 30 days that you need to wait before you could do that. If you do go purchase it within the 30 days, the government's not going to allow you to write off those losses. So you got to be really careful there. They don't want people just going in and selling investments just to take, just to realize the loss and then purchase it back. But what you can do is you could sell it, realize the loss, go purchase another stock or another mutual fund, and that's totally fine. Lastly, if you have more losses than gains, you can actually reduce your ordinary income up to $3,000 per year, right? So let's say you have a total of $20,000 in losses, you have $10,000 in gains. Those losses will wipe out those gains, and then you have a remaining $10,000 in losses. You can take $3,000 and offset your employment income, right? Your W-2 wages, so that can be really great. And then even better, you get to carry over the remaining losses into the next year. So you'd have 7,000 to then carry forward to the next year where you could offset some realized gains, or if you had none, you could do another 3,000 to your ordinary income. So a lot of great strategies that you can do. We like to look at this a lot of times towards the end of the year, which is why we're talking about this. That way you have a good idea of your gains and losses so far. How do your current investments sit with gains and losses? Is there any strategies to try to limit some taxes for you? So if you have some accounts like this and you think it might be beneficial and you're not really sure, come talk to us. We're happy to take a look at it and help save you some tax money. Thank you guys and have a great rest of your day.